So let's play worse funds for your pension, shall we? It's actually it's a pretty tragic game, and we're going to look at some of these, the 10 biggest underperformers by size of fund. These are really popular names. You've got everything from St James's Place Global Quality Fund down 27% over 3 years, underperformance versus the benchmark. Fidelity Global Special Situations, there's another Fidelity one, there's a 91 Global Environment Fund, more Fidelity, Baillie Gifford, Lion Trust. So we're going to go through one or two of these in each of the videos. First thing to remember, this is not individual financial advice. Investing carries, of course, risk to capital. This is for educational purposes and information. It is not a solicitation to buy a particular security, and past performance does not guarantee future returns. Having said that, let's go with Vanguard Life Strategy 100% equity. It's one of the more popular ones. Wasn't one of the big drastic underperformers, but it just shows you even outside the worst performers, there's a lot of bad performance. And I'll tell you what I don't like about this. From 1st of August 2021 all the way to 1st of August 2023, so you're talking 2 years, you've got about a 9% return over those 2 years. That's less than bank interest. You might say, well, those were particularly bad years. Well, 2023 was pretty good, actually, and so was 2021. 2022, I grant you, wasn't the good one. What worries me isn't so much the poor performance. You could pick any 2 years. Okay, 1 year for sure, but any 2 years. What worries me is that, of course, it is a fund which invests in a lot of other funds. So you're being charged by Vanguard on the main fund. Then you're being charged again for all of these sub-funds, which you could simply buy yourself. There's the S&P 500 tracker. Nothing wrong with that. Pretty good, 16% in there. Okay, US Equity Index Fund, similar to the tracker, but never mind, a bit of overlap. Then they've got the UK developed world. I mean, pretty much a bit of everything. Nothing wrong with a bit of everything. What worries me is that once you get below 5%, you've actually got negligible performance. So negligible impact into your fund performance. So the Vanguard FTSE 250, 0.6% is just wasting money. It's just charging fees for doing next to nothing. Similarly, 1.6% in the Pacific. So really, it should be these top four. You can buy those yourselves. They're really easy index trackers. And the US Equity Index Fund and the S&P is actually just pretty much a mirror of each other. So you could get rid of that. You've got the UK, you've got the US tracker and develop. So you're paying quite a lot for basically having three funds. Okay, effectively three funds. Does it overlap with others? And there's too little with others. They're charging you a hell of a lot for that. And worst of all, of course, is when 2022 happens and the markets fall, you'll get a 2-year period with next to no returns anyway. So just be careful because you can't hold cash. They will be invested no matter what. So what's the solution? Well, I would say the solution is learn not to be played. Learn a bit for yourself. Have a look at the links in the bio. Have a look at my campaign for $1million.com. It's got everything that I've written in my Financial Times columns, my various books, on why in investing it's better to know what you're doing yourself, even if all it means is you're not going to handle your own portfolio, but you're going to ask somebody else to do it. So thank you for joining me in this. Like I said, have a look at the links in the bio and I'll cover more funds. So do like, follow and subscribe on the problems with others. Some are worse than others. We're going to go through a whole bundle of them. Thank you very much.